Silver bloodbath, that is what they're calling it. A 6-dot island collapse in hours. New York crashed, Shanghai crashed at the exact same moment, 7,000 miles apart, 12 time zones apart, and yet identical destruction. Coincidence? No. This was coordinated, this was planned, and the evidence, the fingerprints they left behind, will change everything you thought you knew about this market. But here is what they do not want you to understand. This crash, this massacre, is the most bullish signal silver has sent in 50 years. And by the end of this video, you will see exactly why. Welcome to the John Talk Show. For those joining us for the first time, a small request. You have seen markets rise and fall. You have watched cycles come and go. You have earned your experience the hard way, so you understand. Good information is rare and worth protecting. If this channel serves you, if it helps you see what others miss, take one moment, hit that subscribe button, and join a community that values clarity over noise. Now, before we begin, drop a comment below. Let us know, where in the world are you watching from today? New York, London, Dubai, Sydney, we want to hear from you. Now, let us get into it. Something happened on February 2nd, 2026. Something that does not make sense. Unless you understand what is really going on behind the curtain, silver collapsed. Not slowly, not gently, it fell off a cliff. In a single trading session, silver dropped from the mid-80s to $79.89. That is a loss of $6.35. In percentage terms, that is 7.46%, gone in hours. Now, if this were a normal market correction, if this was simply profit taking after a big rally, that would be one thing. Markets go up, markets come down. That is the nature of trading, but this was not normal. Because while silver was crashing in New York, something strange was happening 7,000 miles away in Shanghai. The Shanghai Futures Exchange, one of the largest commodity markets in Asia, was also crashing at the exact same time, with the exact same violence. Silver in New York fell, silver in Shanghai fell. They moved together like two dancers following the same music. But here is the problem. These two exchanges do not share the same music. They do not share the same traders. They do not share the same clearinghouses. They operate in completely different time zones, under completely different regulations, with completely different participants. So how is it possible that both markets crashed at the exact same moment? The answer is simple. It is not possible, not unless someone made it happen. Let us step back and understand what led to this moment. 1 month before the crash, silver was boring. It was trading in the low 30s, $32, $35, nothing exciting, nothing dramatic. Then something changed. The buying started, not small buying, not retail investors picking up a few coins. This was institutional buying, central bank buying, the kind of buying that moves hundreds of thousands of ounces per day. Silver started climbing, $40, $50, $60. It kept going, $70, $80, $90. Then it crossed $100 for the first time in modern history, and then, for one brief moment, silver touched $121 per ounce. $121. That number is important. That number represents a threat to every bank that has sold silver it does not own, a threat to every institution holding short positions, a threat to the entire paper system built on promises that cannot be kept. At $121, the game was over. The losses were too big. The margin calls were too severe. The system was breaking, so they broke it first. Within hours of touching that peak, silver was falling, fast, hard, violent. The crash wiped out weeks of gains in a single session. It took the price from the stratosphere back down to earth, and then kept pushing. Gold did not escape either. Gold fell to $4,672. That is a drop of $216 in one session, a loss of 4.43%. When both metals fall together, when they fall at the same time, with the same intensity, that is not a market, that is a message. Someone is sending a signal. Someone is telling every silver holder, every gold holder, every person who dares to own real money that they are not in control. But here is what makes this crash different from every crash before it. The coordination. 2 exchanges, 2 continents, 2 regulatory systems, 1 crash. The statistical probability of this happening by accident is almost zero. Markets do not move in perfect sync across 12 time zones unless someone is conducting the orchestra, and someone was. The question is, who? Who has the power to crash 2 of the largest commodity exchanges on Earth at the same moment? Who has the resources, the infrastructure, the motive? That answer is coming next. But first, understand this. What happened on February 2nd was not a market event. It was an operation, a coordinated strike, a financial execution designed to break the backs of everyone who believed silver was going higher, and the weapon they used is something most investors have never heard of. There is a weapon in the financial world, a weapon most people have never seen, never heard of, never understood. It does not fire bullets, it does not drop bombs, it does not make a sound. But when it is deployed, fortunes vanish, portfolios collapse, grown men watch their screens in silence as everything they built disappears in minutes. This weapon has a name, the margin hike, and on February 2nd, 2026, this weapon was fired at silver holders with devastating precision. To understand how this weapon works, you must first understand how futures trading operates. When someone buys a silver futures contract, they do not pay the full price up front. They pay a small percentage, called margin. Think of it as a deposit, a down payment, collateral that allows traders to control large positions with relatively small amounts of cash. This is how leverage works. This is how traders amplify their gains. But leverage is a double-edged sword. It amplifies losses too. Now, here is where the weapon comes in. The exchange, the institution that runs the market, has the power to change margin requirements at any time. They can raise them, they can double them, they can triple them, and they can do it overnight with no warning, with no explanation, with no mercy. When margin requirements go up, every trader holding a position suddenly needs more cash. Not tomorrow, not next week, now, immediately. Wire the money or lose your position. And what happens when thousands of traders cannot wire the money fast enough? Forced liquidation. They are forced to sell, not because they want to, not because they think the price is going down, but because the rules changed while they were sleeping. The exchange moved the goalposts, and now they have no choice. Sell or get wiped out. This is exactly what happened on February 2nd. The COMEX, the largest precious metals exchange in the Western world, raised margin requirements on silver futures to levels that can only be described as brutal. The cost of holding a position jumped so high, so fast, that only the largest institutions could afford to stay in the game. Everyone else, out, liquidated, destroyed. But the COMEX was not acting alone. Reports began circulating that the Shanghai Futures Exchange implemented similar measures. The Chinese market operates with less transparency, so exact details are harder to confirm, but the effect was identical. Traders in Shanghai were also forced to sell. Positions were liquidated across Asia just as they were liquidated across America. 2 exchanges, 2 margin hikes, 1 coordinated attack. Now, think about what this means. Thousands of contracts hit the market at once, not because sellers believed silver was overvalued, not because the fundamentals changed, but because they had no choice. They were forced out by a rule change designed to create exactly this outcome. Supply flooded the market, bids disappeared, the price collapsed. This is not supply and demand. This is manipulation disguised as risk management. This is financial warfare dressed up as market regulation. But here is the part that should make your blood boil. While the margin hikes were crushing ordinary traders, while small investors were being liquidated, someone was waiting on the other side. Someone was buying. The same banks that benefit from lower prices, the same institutions with unlimited access to capital. They were scooping up contracts at $79 that were worth $93 just days before. They engineered the crash, then they profited from it. They shook the tree, and they collected every apple that fell. This is not theory, this is not speculation. This is a pattern that has repeated itself for decades in the precious metals markets. Every major silver crash, every sudden collapse follows the same script. Margin hikes, forced liquidation, institutional accumulation at the bottom. The weapon is always the same. The victims are always the same. The beneficiaries are always the same. But this time, something is different. This time, the attack was coordinated across 2 continents. This time, the synchronization was so precise, so obvious, that even mainstream analysts are asking questions. Who gave the order? Who coordinated the timing? Who made sure that New York and Shanghai fired their weapons at the exact same moment? The answer to that question reveals everything. In every crime, there is a question that must be answered before all others. Who benefits? Follow the money, follow the motive, follow the trail of fingerprints left behind, and you will find the hands that pulled the trigger. On February 2nd, 2026, someone crashed the silver market. Someone coordinated an attack across two continents. Someone deployed the margin weapon with military precision. But who? Who has the power to move two of the largest commodity exchanges on Earth at the same moment, in the same direction, with the same result? The list is short, very short. There are only 3 entities on this planet capable of executing an operation of this magnitude. The first suspect sits in Lower Manhattan. The Federal Reserve and its network of primary dealer banks, JP Morgan, Goldman Sachs, Citibank, the usual names, the familiar faces. These institutions have something most traders do not have: unlimited access to capital, direct lines to the central bank, and a very powerful motive. Silver is the enemy of the dollar. When silver rises, it sends a signal that says the paper currency is losing value, a signal that says inflation is real, a signal that says the Federal Reserve has lost control. At $121 per ounce, silver was screaming. It was telling the world that something is broken, that the dollar is sick, that the system is failing. The Fed could not allow that message to spread, so they silenced it. The primary dealer banks hold massive short positions in silver. They have sold contracts for metal they do not possess. When the price rises, they bleed. When the price touches $121, they face extinction. Crashing the price was not optional, it was survival. The second suspect sits in Beijing, the People's Bank of China, and the state-owned enterprises that execute its commands. China has been accumulating silver for years, quietly, systematically, building reserves while the West sleeps. But China does not want to pay high prices. China wants to buy at a discount, and what better way to get a discount than to help crash the market and then scoop up the metal while everyone else is panicking? There is another motive too, a darker one. China and America are locked in an economic war. Currencies, trade, technology, every front is active, every weapon is deployed, crashing silver, destabilizing Western commodity markets, creating chaos in American exchanges. This serves Chinese strategic interests. It weakens confidence in dollar-denominated assets. It accelerates the shift away from Western financial dominance. The third suspect is the most troubling of all. What if it was both? What if the Federal Reserve and the People's Bank of China, despite their public rivalry, despite their competing interests, found common ground on this one issue? Think about it. The Fed wants lower silver prices to protect the dollar and save the short positions of its primary dealers. China wants lower silver prices to accumulate more metal at cheaper levels. Both sides benefit from the same outcome. Both sides have the infrastructure to coordinate. Both sides have the motive to cooperate, even while they compete on every other front. This is the nightmare scenario: East and West working together to suppress the one asset that threatens both of their paper currency systems. The evidence supports this theory. The timing was too perfect. The synchronization was too precise. 2 exchanges, 12 time zones apart, crashing within minutes of each other. This does not happen by accident. This does not happen through coincidence. This happens through coordination. Someone made a phone call, someone sent a message, someone ensured that when the margin hikes hit, they hit everywhere, all at once, with maximum impact. The fingerprints are there, the motive is there, the capability is there. But here is what the suspects did not count on. Their attack, their coordinated assault, their desperate attempt to crush silver has revealed something they wanted to keep hidden. It has revealed how scared they are when you must cheat this openly, when you must coordinate across continents, when you must deploy every weapon in your arsenal just to knock the price down temporarily. You are not winning, you are losing. Here is the question that separates those who understand from those who will be left behind. If silver is worthless, if it is just a relic, if it has no future, then why attack it? Why coordinate across 2 continents? Why deploy margin hikes? Why engineer a crash that required cooperation between rivals? You do not fight something that does not matter. You do not spend resources suppressing something that poses no threat. You do not expose yourself, reveal your tactics, burn your ammunition, unless you are fighting for survival. The violence of this crash is the confession. They are afraid, and what they are afraid of is what comes next. Let us talk about the physical market. Because while the paper price was collapsing on screens around the world, something very different was happening in the real world. Bullion dealers across America reported the same thing. Premiums were spiking, the extra cost above the spot price, the amount you must pay to actually hold metal in your hand, doubled in some cases, tripled in others. Wholesalers ran low on inventory. Refiners reported backlogs stretching weeks into the future. Mints were operating at full capacity and still could not meet demand. This is the crack in the system. This is the truth they cannot hide. The screen says $79, but try to buy an ounce of silver at $79. Try to take delivery. Try to hold the metal in your hand. You will discover that the screen is lying. The paper price and the physical price are separating. They are moving in opposite directions. Paper is falling. Physical is disappearing. This divergence cannot last forever. One of two things must happen. Either the paper price must rise to match physical reality, or the paper market must collapse entirely, and physical silver will trade in its own universe at prices the screen never showed. Either outcome is catastrophic for those holding paper. Either outcome is victory for those holding metal. Now let us examine why physical demand is not going away, why it cannot go away, why no amount of margin hikes can stop what is coming. Solar energy. The world has committed trillions of dollars to green energy. Governments have signed agreements. Corporations have made pledges. The transition is happening whether markets like it or not. And every solar panel requires silver. The photovoltaic cells that convert sunlight into electricity. They are built with silver paste. There is no substitute. There is no alternative. You cannot make a solar panel without silver. By 2030, solar installations alone will consume over 200 million ounces of silver per year. That is more than 20% of total global mine supply, just for solar. Add electric vehicles. Every EV contains 25 to 50 grams of silver in battery connectors and charging systems. Global EV production is heading toward 20 million units per year. That is another 15 million ounces of annual demand. Add 5G networks. Every cell tower, every base station, every relay node contains silver components. The global build-out represents tens of millions of additional ounces. Add medical devices, add electronics, add water purification, add military applications. The demand is structural, it is permanent, it is growing, and supply is stuck. Global silver mine production sits around 800 million ounces per year. That number has been flat for a decade. Mining companies are not finding new deposits. Ore grades are declining. The easy silver has been extracted. What remains is deeper, more expensive, harder to reach. The math does not lie. Demand is rising. Supply is flat. The deficit is widening every year. This is why they attacked. This is why they coordinated. This is why they deployed every weapon available, because they know what is coming. They know the physical market is draining. They know the vaults are emptying. They know that every day they suppress the price. More metal flows east and less metal remains in Western hands. They are buying time, but time is running out. Here is the timeline. Over the next few weeks, they will try to keep silver pinned below $80. They will paint the charts red. They will send analysts on television to say the rally is over. Do not believe them. By March and April, industrial buyers will need metal for second quarter production. Solar manufacturers have orders. Electronics companies have components to build. They will bid aggressively for physical. By summer, the cracks will widen. Someone will announce they cannot source the metal they were promised. That announcement will trigger panic. Paper holders will rush to convert. Premiums will explode, and then the world will wake up. The $79 on the screen this morning is not a warning to sell. It is an invitation to buy. It is a gift, wrapped in fear, delivered by desperate institutions who are running out of options. Those who understand will act. Those who hesitate will watch from the sidelines as history unfolds without them. The crash was coordinated. The evidence is clear. The fingerprints are visible. But the signal, the true signal, is this. When empires cheat, the game is almost over. Hold the metal. Ignore the noise. The endgame is inevitable.